Welcome to the first course in the Certificate in Marine Insurance, the Evolution and History of Marine Insurance. My name is Dr. Logan Welch, and I am honored to guide you through this journey into the rich history and development of an industry that has safeguarded global trade and the movement of goods across oceans for centuries. In this introductory series, we will explore how marine insurance has transformed from ancient practices of shared maritime risk to the complex, regulated industry we recognize today. Our study begins with the origins of marine insurance, delving into the early practices of commerce that emerged along ancient trade routes. Here we'll examine the principle of general average, an early form of shared risk that laid the groundwork for marine insurance by distributing the costs of cargo loss across multiple parties. From there, we'll explore the concept of bottom-re bonds, a precursor to modern policies that allowed merchants to secure their investments in perilous voyages. In our journey through history, we will pause at the key hubs of Grecian and Roman commerce, examining how structured risk management practices first took form. We will then explore the Middle Ages, an era shaped by the influence of the Hanseatic League, a powerful merchant guild that established early codes and regulations for maritime trade. Their influence laid the legal foundations that would govern marine insurance for centuries to come. We will also dive into the transformative Age of Discovery, when European explorers set sail across uncharted waters, necessitating an expansion in marine insurance. As global trade routes stretched across continents, new challenges emerged, and we'll follow the Lombards to England, where London's marine insurance market began to take shape. Key milestones, such as the founding of Lloyd's Coffee House, widely regarded as the birthplace of modern underwriting, and England's first marine insurance statute, will illustrate the evolution from individual underwriters to corporate entities. Our course will continue to trace these developments across the Atlantic, to early marine insurance in the United States, where the rise of American commerce spurred the growth of domestic insurers and legislation. We will discuss legal milestones, such as those set by Lord Mansfield, which established vital precedents for marine insurance law, and consider the rise of organized corporations that would soon dominate the industry. As we progress, we'll enter the dynamic period of the clippership era, a time when new types of vessels and insurance fraud challenged the industry, and then navigate through the Civil War, a period marked by a revival and adaptation in marine insurance. Moving forward, we'll explore the post-war developments and how the onset of global conflicts such as World Wars I and II forced the marine insurance industry to adapt to unprecedented risks. A defining moment in our history will be the passage of the Marine Insurance Act of 1906, which codified many industry standards that persist today. This act served as a beacon of regulation, ensuring clarity and consistency within the field. Our study will culminate in a reflection on how historical practices have evolved into today's modern insurance frameworks, bridging centuries of tradition with contemporary challenges. This course, divided into 20 in-depth lectures, will offer you a comprehensive view of marine insurance's evolution, bringing you closer to understanding not only its historical significance, but also its critical role in supporting global commerce today. I encourage you to approach each lecture with curiosity and an open mind, as together we uncover the fascinating legacy of marine insurance and its journey from ancient practices to the global industry it is today. The origins of marine insurance trace back to the need for risk management within ancient trading practices, where early civilizations such as the Babylonians, Greeks, and Phoenicians laid foundational concepts. The development of primitive insurance systems was born out of the economic imperatives of maritime trade, which, given the unpredictability of sea voyages, necessitated some form of financial safeguard. In the Babylonian civilization around the 2nd millennium BCE, the Code of Hammurabi introduced a legal framework that allowed merchants to shift some of the risks associated with their trade. This code, one of the earliest recorded legal documents, included a concept known as bottomry, a contract in which a lender would finance a seafaring merchant's voyage in exchange for repayment with interest upon successful completion. However, if the voyage was unsuccessful due to maritime perils, the loan was forgiven. This early example of risk transfer reflects the underlying principles of modern marine insurance, where the lender absorbed part of the risk associated with the journey, allowing merchants to pursue ventures that might otherwise be prohibitively risky. In ancient Greece, similar practices emerged as trade expanded across the Mediterranean Sea, becoming a crucial economic activity linking various Greek city-states. Greek merchants and financiers developed a form of maritime loan that operated on a principle similar to bottomry but added an explicit interest rate linked to the risk of the journey, creating what could be considered one of the first proto-insurance premiums. This system was particularly significant as it formalized the association of risk with financial cost, a concept central to contemporary insurance practices. Greek philosophers such as Aristotle and Demosthenes, while not directly involved in commerce, referenced these practices, noting the risks and rewards embedded in maritime ventures. The maritime loan provided essential liquidity for merchants, allowing the Greek economy to flourish and facilitating the spread of goods, ideas, and cultural exchange across the ancient world. Through these practices, Greek merchants could mitigate losses from shipwrecks, piracy, and natural disasters, which were common occurrences that otherwise could devastate individual traders or entire trading networks. The Phoenicians, known for their seafaring skills and vast trading networks across the Mediterranean, developed one of the most complex early risk management systems due to their dependence on long-distance trade. Operating from their coastal cities in present-day Lebanon, Phoenician traders extended their routes as far as the British Isles and West Africa, necessitating innovative methods for managing the high risks associated with their far-reaching voyages. They utilized a combination of maritime loans, partnerships, and profit-sharing agreements, creating a rudimentary form of pooled risk that allowed multiple investors to share both profits and losses. This early pooling concept can be seen as a precursor to modern mutual insurance, where policyholders collectively bear risks. The Phoenicians' trade practices were further sophisticated by their interactions with various cultures, adopting and adapting risk management concepts as they moved goods like glass, purple dye, and metal across hazardous waters. Their role in shaping risk-sharing mechanisms was crucial for subsequent civilizations, as the stability provided by these practices encouraged the growth of more complex economies and maritime ventures. The contributions of these ancient societies not only laid a practical groundwork for marine insurance, but also sparked theoretical debates about risk, finance, and mutual benefit that would resonate through subsequent centuries. These early systems fostered a view of risk that intertwined with moral and legal considerations, as evidenced by the Babylonian and Greek legal codes that detailed the responsibilities of both borrower and lender in maritime transactions. Notably, Roman law later adopted and expanded upon these principles, setting the stage for the more sophisticated insurance frameworks that would emerge in medieval Europe. The Roman lex rhodia on jettison, a principle governing the equitable distribution of losses in maritime emergencies, provided an early legal basis for what is now known as general average, a principle still used in marine insurance today to ensure that all parties involved in a voyage contribute proportionally to losses incurred during the voyage for the common good. Through these ancient commercial practices, fundamental components of risk distribution, legal obligation, and financial protection became ingrained in the commercial activities surrounding maritime trade. Although primitive, these systems reflect a sophisticated understanding of the economic impact of risk and the need for frameworks that allowed for commercial continuity despite natural and human-made hazards. The legacy of Babylonian bottomry contracts, Greek maritime loans, and Phoenician risk pooling agreements offers insights into how societies across history approached the volatility inherent in maritime ventures. These early risk management methods underscore a progression from individual risk-taking to collective responsibility and formalized financial protection, marking a historical continuum that underpins modern insurance theory. Scholars such as John Phillips and Philip Hellwedge have noted that without these ancient risk management frameworks, the expansion of trade networks, and by extension the development of global commerce, would have been severely constrained, illustrating the profound influence of early marine insurance practices on economic history. The convergence of trade, legal innovation, and risk-sharing in ancient societies thus provides a crucial foundation for understanding how marine insurance evolved into the sophisticated, regulated industry we recognize today, where contemporary risk managers, underwriters, and insurers continue to apply these timeless principles to mitigate the ever-present risks of the principle of general average, a fundamental doctrine of maritime law, represents one of the oldest and most enduring mechanisms of mutual risk-sharing in commerce. Its origins can be traced back to ancient Mediterranean trade, particularly within Greek and Roman legal traditions, where early maritime codes such as the Rhodian Sea Law, codified around the 7th or 8th century BCE, first articulated the concept. The principle stipulates that when extraordinary sacrifices or expenditures are made intentionally to preserve a maritime venture, the resulting losses are shared proportionately among all parties with a vested interest in the voyage, including ship owners, cargo owners, and, in some cases, charterers. This doctrine emerged as a pragmatic solution to the inherent uncertainties of sea trade, where storms, piracy, and navigational errors often posed existential risks to commercial ventures. Its enduring significance lies in its ability to balance individual and collective interests, ensuring that no single party bears an undue burden in the face of shared adversity. From a theoretical perspective, general average is grounded in the notion of equitable distribution of loss, drawing upon principles of fairness and collective responsibility. This aligns with broader social and legal theories of mutual aid and risk distribution, which were particularly vital in ancient economies characterized by high-risk ventures. In practice, the application of general average is contingent upon three primary criteria: the presence of a voluntary and intentional sacrifice, the necessity of the action to preserve the maritime venture, and the success of the sacrifice in achieving this objective. For example, jettisoning cargo to stabilize a vessel imperiled by rough seas would constitute an act of general average, provided that the sacrifice was calculated and necessary to avert total loss. Historical accounts of Mediterranean trade suggest that merchants commonly documented such decisions through detailed manifests and agreements, laying the groundwork for the legal codification of these practices. By the medieval period, the principle of general average had become a cornerstone of maritime law across Europe, influencing key legal texts, such as the Consolato del Mare, a seminal compilation of Mediterranean maritime customs and laws dating back to the 14th century. This text explicitly outlined the procedures for declaring general average, including the apportionment of losses among stakeholders. It also introduced the role of the average adjuster, a neutral party tasked with calculating contributions based on the value of the cargo and ship, a practice that remains integral to modern applications of the principle. The concept was further refined during the Age of Exploration, when the expansion of global trade routes magnified the complexities of maritime risk management. In England, for instance, the York-Antwerp Rules of 1890 formalized a set of international standards for the calculation and application of general average, providing a uniform framework for resolving disputes among multinational stakeholders. In contemporary maritime practice, general average continues to play a critical role, particularly in large-scale shipping operations involving high-value cargo and complex logistics. Modern interpretations of the principle are governed by international conventions, with the York-Antwerp Rules serving as the primary reference for determining general average claims. These rules, revised periodically to reflect changes in shipping technology and legal norms, delineate specific categories of allowable sacrifices and expenditures, such as the cost of firefighting efforts or the use of tugboats to avert collisions. The principle's relevance has been highlighted in recent high-profile cases, such as the grounding of the Ever Given container ship in the Suez Canal in 2021, where claims of general average were invoked to address the multi-million-dollar costs associated with freeing the vessel and mitigating subsequent damages. However, the application of general average is not without controversy. Critics argue that the principle, while rooted in fairness, can impose significant administrative and financial burdens on stakeholders, particularly in cases involving extensive litigation or disputed valuations of cargo and losses. Additionally, advances in maritime insurance have shifted much of the financial risk associated with shipping losses, raising questions about the continued necessity of general average in its traditional form. Some scholars advocate for its integration with modern risk management practices, such as predictive analytics and automated claim adjustment processes, to streamline its implementation and enhance its efficiency. Others caution against eroding a principle that has fostered a sense of collective accountability among maritime stakeholders for centuries, emphasizing its historical and ethical significance in balancing individual and communal interests. These debates underscore the multifaceted nature of general average, which intersects with disciplines as diverse as legal theory, economics, and maritime history. Its enduring relevance reflects the complexity of balancing risk and reward in an increasingly interconnected global economy, where maritime trade continues to serve as a vital conduit for commerce and cultural exchange. By examining its historical evolution, theoretical foundations, and contemporary applications, we gain a deeper understanding of how general average embodies the timeless challenges and opportunities of maritime enterprise. The ongoing applicability of general average underscores the intricate balance it maintains between legal, economic, and operational considerations in the maritime industry. For instance, in the operational realm, the practical execution of general average claims necessitates meticulous documentation and valuation processes. Cargo manifests, ship logs, and detailed records of the voyage are integral to establishing the validity of a general average act. The role of the average adjuster becomes crucial here. These professionals, often with specialized training in maritime law and accounting, serve as neutral arbitrators to calculate each stakeholder's proportional contribution. Their calculations are guided by both the York-Antwerp rules and any specific contractual agreements between the shipowner and cargo interests, ensuring consistency and fairness in the apportionment of losses. Economically, General Average acts as a stabilizing mechanism for stakeholders in the maritime supply chain, fostering a degree of predictability in the inherently uncertain realm of ocean trade. It operates in tandem with marine insurance, often serving as a complementary rather than redundant framework. While hull and cargo insurance policies typically cover general average contributions, insurers require shippers to post a general average bond or guarantee before releasing cargo held as security for pending claims. This intersection of general average and insurance underscores the principle's enduring relevance, as it facilitates financial recovery and ensures continuity in maritime commerce. However, it also highlights the principle's complexity, as the need for bonds and guarantees can delay cargo delivery, adding to the operational burdens of already strained supply chains. From a legal perspective, General Average continues to be shaped by evolving jurisprudence and international agreements. Disputes often arise over the classification of particular sacrifices or expenditures, especially in cases involving new technologies or unconventional maritime practices. For example, the growing use of autonomous ships and advanced firefighting systems presents novel scenarios that challenge traditional interpretations of General Average. In such cases, courts and arbitration panels must weigh historical precedents against contemporary realities, often resulting in incremental adaptations of the York-Antwerp rules. These adaptations are critical for maintaining the principle's relevance while preserving its foundational ethos of equitable loss distribution. The principle also engages broader ethical and philosophical debates about the nature of collective responsibility. Scholars in the field of maritime history and law frequently highlight General Average as a microcosm of societal efforts to balance individual rights with communal obligations. The act of voluntarily sacrificing a portion of cargo for the greater good mirrors broader themes in public policy and risk management, such as the allocation of resources in disaster response or the regulation of financial markets to mitigate systemic risks. This analogy reinforces the idea that General Average is not merely a technical rule of maritime law, but a reflection of deeper social values and norms that transcend its immediate context. In contemporary discussions, General Average intersects with issues of environmental sustainability and corporate accountability in the shipping industry. Modern shipping companies face increasing scrutiny over their environmental practices, with stakeholders demanding greater transparency and responsibility in addressing maritime disasters. For example, when oil tankers or large container ships encounter emergencies requiring General Average sacrifices, the environmental implications of actions like jettisoning cargo are subject to heightened examination. Regulators and environmental advocacy groups argue that such sacrifices, while legally justified, must also align with broader sustainability goals, prompting calls for more stringent guidelines and oversight mechanisms. Moreover, the principle of General Average is beginning to intersect with the digitization of the maritime industry. The adoption of blockchain technology and digital ledgers offers the potential to streamline General Average processes by providing real-time, tamper-proof records of cargo ownership, valuations, and voyage details. These technological advancements could reduce the administrative burdens associated with calculating and enforcing General Average contributions, making the principle more efficient and accessible in a globalized economy. However, they also raise questions about data privacy, cybersecurity, and the equitable integration of technology across different stakeholders, particularly smaller operators who may lack the resources to adopt such systems. Despite these advancements, the fundamental challenges of General Average remain rooted in the inherent uncertainties of maritime trade. Unpredictable weather patterns, geopolitical tensions, and the increasing complexity of global supply chains continue to test the resilience of the principle. For instance, the rise of megaships capable of carrying tens of thousands of containers amplifies the stakes of General Average incidents, as the potential losses and corresponding contributions grow exponentially. This scale raises practical concerns about the feasibility of calculating and collecting contributions from a diverse array of stakeholders, particularly when cargo ownership is fragmented across multiple parties and jurisdictions. As we delve deeper into the nuances of General Average, it becomes evident that the principle is not merely a relic of ancient maritime practice, but a living framework that evolves in response to the changing dynamics of global trade. Its enduring relevance lies in its ability to adapt to new challenges while preserving its core purpose: to distribute losses equitably and ensure the collective resilience of maritime ventures. The ongoing evolution of general average, driven by legal, technological, and economic forces, offers valuable insights into the broader interplay between tradition and innovation in the maritime industry. Each new development, whether a refinement of the York-Antwerp rules or the integration of blockchain technology, adds another layer to the rich tapestry of general average, reaffirming its central role in the complex and ever-changing world of maritime commerce. Bottom-re bonds represent a fascinating and foundational practice in the development of modern marine insurance, offering critical insights into the evolution of financial risk management and contractual obligations in maritime commerce. Emerging in ancient maritime societies, the practice of bottomry involved ship owners securing loans by using their vessels or the anticipated value of their cargo as collateral. The unique feature of bottomry was that repayment of the loan, including the agreed-upon interest, was contingent upon the safe arrival of the ship and its cargo at the designated port. This arrangement meant that if the ship was lost due to a peril of the sea, such as a storm, pirate attack, or shipwreck, the loan would not need to be repaid. Bottomry agreements thus acted as an early form of insurance, transferring the risk of maritime loss from the ship owner to the lender while ensuring the continued flow of capital to support trade. Historically, the concept of bottomry can be traced back to ancient civilizations, including the Babylonians, Greeks, and Romans. The earliest known mention of bottomry-like practices is found in the Code of Hammurabi, circa 1750 BCE, which outlined provisions for loans tied to maritime ventures. Greek maritime laws, such as the Rhodian Sea Law, circa 800 BCE, also codified similar arrangements, emphasizing the shared risks between lenders and borrowers in maritime trade. In Roman law, bottomry bonds were formalized under the term foenus nauticum, meaning maritime loan. Roman jurists such as Ulpian further refined the legal framework, distinguishing bottomry from usury by allowing higher interest rates to compensate lenders for the additional risks associated with sea travel. This legal distinction underscored the high-risk nature of maritime ventures and recognized the need for financial instruments tailored to such unique challenges. The structure of a bottomry contract typically included detailed terms specifying the loan amount, the duration of the voyage, the collateral, usually the ship and its cargo, and the agreed-upon interest rate, often referred to as maritime interest. Unlike traditional loans, where interest was tied to a fixed timeline, maritime interest was calculated based on the voyage's success and the level of risk involved. For example, voyages through dangerous waters known for piracy or storms often carried higher rates of interest. This created a dynamic pricing system that reflected the lender's risk exposure and allowed for the equitable allocation of financial responsibility in maritime ventures. In some cases, the contracts also included a stipulation allowing the lender to inspect the ship's seaworthiness, ensuring that the risk was not exacerbated by negligence on the part of the shipowner. In practical terms, bottomry bonds served several key functions in ancient and medieval maritime economies. First, they facilitated trade by providing shipowners with the necessary funds to undertake long and often perilous voyages. This was particularly critical in an era when maritime commerce was the backbone of economic activity, connecting distant markets and enabling the exchange of goods such as spices, silk, and precious metals. Second, bottomry agreements incentivized lenders to invest in maritime ventures by offering potentially high returns while limiting their liability to the voyage's outcome. This not only encouraged capital investment in shipping, but also fostered innovation in shipbuilding and navigation, as shipowners sought to minimize risks and ensure successful voyages. Third, the practice of bottomry introduced a form of collective risk sharing, wherein the financial burden of maritime losses was distributed between multiple stakeholders, reducing the economic impact of individual disasters. As the practice of bottomry evolved, it began to influence the development of more sophisticated marine insurance mechanisms, particularly in medieval Europe. By the 13th century, Italian city-states such as Genoa, Venice, and Florence had adopted and adapted bottomry principles, integrating them into their burgeoning financial and legal systems. For instance, the Commenda, a partnership-based investment structure used in Genoa, borrowed heavily from bottomry by allowing passive investors to share in the profits or losses of a maritime venture. Similarly, Venetian merchants developed early forms of marine insurance policies that formalized the separation of financial risk from operational risk, laying the groundwork for modern underwriting practices. One of the most significant contributions of bottomry to the field of marine insurance was its role in shaping the legal and ethical frameworks governing risk and liability. By linking the repayment of loans to the successful completion of a voyage, bottomry contracts established the principle of indemnity, a cornerstone of modern insurance law. This principle holds that financial compensation should be proportional to the actual loss incurred, thereby discouraging fraudulent claims and ensuring equitable outcomes for all parties involved. Furthermore, the use of collateral in bottomry agreements highlighted the importance of assessing and managing risk, a practice that remains central to contemporary underwriting processes. Despite its historical significance, bottomry also faced criticism and challenges, particularly concerning its moral and legal implications. In many jurisdictions, the practice was scrutinized for its resemblance to usury, as the high interest rates often charged on bottomry loans exceeded the limits imposed by religious or civil authorities. The Catholic Church, for example, condemned excessive maritime interest as exploitative, prompting the development of alternative financing methods such as mutual insurance pools. Additionally, the reliance on collateral created potential conflicts of interest as ship owners who defaulted on their loans risked losing their primary source of livelihood. These ethical dilemmas spurred ongoing debates about the balance between profit and fairness in financial transactions, debates that continue to shape the insurance industry today. From a theoretical perspective, bottomry can be seen as an early application of risk theory and financial hedging. By transferring the uncertainty of maritime ventures from ship owners to lenders, bottomry bonds effectively distributed financial risks across a broader network of stakeholders. This not only stabilized individual enterprises, but also contributed to the resilience of the broader maritime economy. The integration of bottomry principles into legal codes and commercial practices further demonstrated the interplay between law, economics, and maritime technology, offering valuable lessons for modern policymakers and industry leaders. In contemporary discussions, bottomry is often cited as a precursor to the Lloyd's system of marine insurance, which emerged in 17th century London. Like bottomry, the Lloyd's system relied on a network of investors who shared the risks and rewards of insuring maritime ventures. However, unlike bottomry, Lloyd's introduced the concept of pooling risks across multiple voyages and clients, creating a more diversified and sustainable model for managing maritime losses. This evolution underscores the enduring relevance of bottomry as a foundation for understanding the principles and practices of modern insurance. The development of formalized risk-sharing arrangements in ancient Grecian marketplaces represents one of the most transformative shifts in the history of commerce, intertwining economic ingenuity with the structural necessities of maritime trade. In ancient Greece, the confluence of expanding trade networks, a robust maritime economy, and the inherent unpredictability of sea voyages catalyzed the emergence of early risk management practices. The Grecian city-states, particularly Athens, Corinth, and Rhodes, functioned as bustling hubs of commerce where merchants and shipowners sought practical solutions to mitigate the financial risks posed by storms, piracy, and shipwrecks. The foundational framework for these arrangements stemmed from the concept of mutual aid, deeply embedded in Grecian culture and evidenced in both social and economic activities. Early forms of risk-sharing were informal and rooted in collective agreements among merchants. These agreements often operated on principles that would later underpin structured insurance systems, such as the distribution of losses across a group to reduce the individual burden. For instance, merchants transporting goods across the Aegean Sea would pool resources to create a shared fund that could be accessed in the event of a loss. These arrangements, although rudimentary, represented the genesis of formalized insurance exchanges and were supported by Grecian norms of trust and accountability. This cultural bedrock was critical in fostering an environment where merchants could collaborate despite the absence of centralized regulatory systems. The establishment of the first insurance exchanges in Grecian commerce can be traced to the development of maritime lending practices, notably bottomry and respondentia loans, which were formalized in Grecian maritime law. Bottomry loans allowed ship owners to secure financing for voyages by pledging their vessel as collateral, with the repayment contingent upon the successful return of the ship. If the ship were lost due to perils of the sea, the debt would be forgiven. Respondentia loans extended this principle to the cargo being transported, providing merchants with a parallel mechanism to protect their investments. These loans not only facilitated trade by ensuring liquidity, but also created a contractual framework for risk sharing, setting a precedent for later insurance instruments. The legal codification of these practices played a pivotal role in their durability and widespread adoption. The Rhodian Sea Law, one of the earliest maritime codes originating from the island of Rhodes, provided a sophisticated legal framework for addressing issues related to average contributions, a concept akin to modern general average. General average required all stakeholders in a maritime venture to proportionally share the financial burden of losses incurred for the common good, such as jettisoning cargo to save a vessel during a storm. This principle was revolutionary in its ability to balance interests among shipowners, merchants, and financiers, ensuring equitable risk distribution and promoting sustained commercial activity. The Rhodian Sea Law's emphasis on fairness and collective responsibility had far-reaching implications, influencing the development of Roman law and, subsequently, medieval European maritime codes. The practical application of these early insurance-like arrangements extended beyond financial instruments to encompass physical risk management strategies. Grecian marketplaces, particularly in port cities, were meticulously organized to facilitate the efficient exchange of goods and minimize exposure to theft or damage. Warehouses, known as emporia, were strategically located near harbors, and their design reflected an acute understanding of the logistical and security challenges of maritime trade. Merchants often formed syndicates to jointly invest in storage facilities and employ guards, further demonstrating the integration of collective risk mitigation into everyday commercial practices. These syndicates also played a crucial role in disseminating information about market conditions, shipping routes, and potential hazards, underscoring the importance of shared knowledge in managing uncertainty. From a theoretical perspective, the development of these early insurance mechanisms can be understood through the lens of risk theory and economic sociology. The Grecian approach to risk sharing exemplified a shift from reactive to proactive risk management, aligning with the principles of social contract theory. By entering into mutual agreements, merchants effectively created a proto-insurance network that balanced individual autonomy with collective responsibility. This interplay between individual and group dynamics remains a cornerstone of modern insurance systems. Furthermore, the Grecian emphasis on trust and reputation as critical components of these arrangements highlights the sociological underpinnings of economic transactions, where relational capital often outweighed formal contractual obligations. The impact of Grecian insurance exchanges on maritime law and subsequent economic systems cannot be overstated. The principles established in this era laid the groundwork for the institutionalization of insurance during the medieval period, as evidenced by the adoption of maritime lending practices in Italian city-states such as Venice and Genoa. These practices evolved into marine insurance contracts, which were formalized in the 12th and 13th centuries. Moreover, the Grecian model of risk-sharing influenced the development of actuarial science by highlighting the importance of probability and statistical analysis in assessing and pricing risk. Although these advancements would not materialize until centuries later, the conceptual seeds were undoubtedly sown in the Grecian marketplaces. The emergence of formalized risk-sharing in Grecian commerce also prompts contemporary debates about the ethical and economic implications of risk distribution. Modern insurance systems grapple with questions of moral hazard, adverse selection, and equity, issues that can be traced back to the inherent tensions in the Grecian approach. See, for instance, the reliance on collective funds to compensate for individual losses raises concerns about accountability and incentivization, challenging the sustainability of such arrangements. Additionally, the Grecian emphasis on mutual aid contrasts with the profit-driven motives of modern insurance companies, prompting discussions about the role of social solidarity in contemporary economic systems. In analyzing the depth and breadth of Grecian contributions to structured risk management, one must consider the broader historical context that shaped these innovations. The geographical and political fragmentation of the Grecian world necessitated a high degree of adaptability and resilience among its merchants. The constant threat of warfare, piracy, and natural disasters underscored the urgency of developing robust risk management practices, fostering a culture of ingenuity that remains a hallmark of Grecian commerce. Furthermore, the intellectual traditions of Greece, with their emphasis on logic, mathematics, and philosophy, provided a fertile ground for the theoretical exploration of risk, as evidenced in the writings of thinkers such as Aristotle, who discussed the concept of contingency in his works. This intricate interplay of cultural, economic, and intellectual factors underscores the significance of Grecian contributions to the evolution of risk management and insurance. By examining these early practices through a multidisciplinary lens, we gain not only a deeper understanding of their historical impact, but also valuable insights into the enduring challenges and opportunities of structured risk sharing in an increasingly complex and interconnected world. The analytical examination of these foundations provides a rich tapestry of interconnected developments that shape the trajectory of maritime commerce, insurance law, and economic theory, revealing the profound legacy of Grecian innovation in the realm of risk management. The development of marine insurance, which has become a cornerstone of global trade, can be traced back to the vibrant mercantile activities of the Carthaginians and its subsequent codification within the legal framework of the Roman Empire. Carthage, a dominant naval and commercial power in the Mediterranean during the first millennium BCE, established extensive trade networks stretching across North Africa, southern Europe, and the Near East. The Carthaginians, relying on their naval supremacy, facilitated the transport of high-value goods such as grain, wine, and precious metals. This necessitated risk management practices to mitigate the dangers posed by piracy, storms, and other maritime perils. Historical accounts suggest that Carthaginian merchants likely developed primitive risk-sharing agreements, whereby ship owners and merchants collectively pooled resources to offset losses incurred by individual contributors. While explicit written records of Carthaginian insurance practices are scarce, the indirect evidence of their advanced maritime laws and trade agreements indicates the early emergence of proto-insurance mechanisms. The Romans, inheriting and expanding upon Carthaginian mercantile traditions following the Punic Wars, integrated these concepts into their sophisticated legal system, which was grounded in principles of equity and contract law. Roman maritime law evolved significantly during the Republic and the Empire, as exemplified in the Lex Rhodia de Iactu, or the Rhodian Law of General Average, which likely originated from earlier Greek maritime codes, but was adopted and refined by Roman jurists. This law codified the principle that when cargo was jettisoned to save a vessel during distress, the resulting loss would be shared proportionally among all stakeholders, including the ship owner and the merchants whose goods were spared. Such practices underscored a communal approach to risk distribution, laying the groundwork for modern marine insurance. In addition to the Rhodian principles, Roman law also formalized contracts for loans on maritime ventures, known as foenus nauticum. These contracts, which were distinct from ordinary loans, allowed lenders to charge higher interest rates to account for the elevated risks of seafaring trade. The interest payments were contingent upon the safe arrival of the ship and its cargo, effectively transferring the financial risk of maritime losses from the borrower to the lender. This arrangement bears resemblance to contemporary marine insurance policies, as it demonstrated the conceptual separation between physical ownership and financial liability for maritime risks. Roman legal scholars, including Gaius and later Justinian, incorporated these principles into broader legal frameworks, ensuring their dissemination across the empire through comprehensive legal codices such as the Corpus Juris Civilis. This codification process not only preserved these practices, but also facilitated their transmission to successor states in medieval Europe. The influence of Roman maritime law extended far beyond its immediate application in the Mediterranean. As Roman territories encompassed key trading hubs, including Alexandria, Antioch, and Carthage, their legal principles shaped the commercial norms of a diverse array of cultures. The universality of Roman law, coupled with the empire's extensive trade networks, enabled the standardization of maritime practices across regions as diverse as the Black Sea, the Red Sea, and the Atlantic coasts of Europe and North Africa. The enduring impact of Roman legal traditions is evident in the evolution of medieval maritime codes, such as the Consulate of the Sea in the Mediterranean and the roles of Oleron in the Atlantic, which retained core elements of Roman doctrines on risk-sharing and liability apportionment. In analyzing the transition from Carthaginian to Roman maritime practices, it is essential to consider the economic, political, and technological factors that facilitated this evolution. The expansion of Roman naval capabilities, for instance, provided a measure of security against piracy, thereby reducing the overall risk environment for merchants. Concurrently, the development of standardized ship designs and navigation techniques contributed to more predictable and efficient trade routes. These advancements, combined with the stability afforded by Roman governance, created an environment conducive to the growth of institutionalized risk management mechanisms. Additionally, the Roman emphasis on written contracts and formalized dispute resolution processes ensured the enforceability of agreements, further enhancing the reliability of maritime commerce. The theoretical foundations of Roman maritime insurance practices also warrant examination. Roman jurisprudence, influenced by Stoic philosophy, emphasized rationality, proportionality, and the equitable distribution of burdens. These principles underpin the legal constructs governing maritime risk, fostering a sense of shared responsibility among stakeholders. Furthermore, the integration of maritime law into broader legal codices exemplifies the Roman commitment to systemic coherence and universality, characteristics that would later influence the codification efforts of European states during the Enlightenment. From a practical perspective, the Roman approach to maritime insurance demonstrated remarkable adaptability to diverse economic contexts. The prevalence of mixed cargoes, for instance, necessitated complex arrangements for risk apportionment, as goods of varying value and perishability required differentiated treatment. Roman contracts often specified the precise terms of liability, reflecting a nuanced understanding of the economic and logistical realities of maritime trade. This adaptability ensured the relevance of Roman maritime law across a wide range of scenarios, from local coastal trade to long-distance voyages connecting the Mediterranean to the Indian Ocean. Contemporary debates surrounding the legacy of Roman maritime insurance often center on its role in shaping modern legal and economic systems. While some scholars argue that Roman practices represent the direct antecedents of modern insurance frameworks, others contend that their influence was more diffuse, mediated through medieval and Renaissance reinterpretations. Nonetheless, the conceptual and structural innovations introduced by Roman law remain foundational to the field of marine insurance, as evidenced by their enduring presence in legal doctrines and commercial practices worldwide. The Hanseatic League, an influential confederation of merchant guilds and market towns from the 12th to the 17th centuries, played a pivotal role in shaping the commercial and maritime practices of the Middle Ages. Emerging amidst the socio-political fragmentation of medieval Europe, the League established a robust network that extended across the Baltic and North Seas, linking over 100 cities such as Lübeck, Hamburg, Bremen, and Bruges to key markets in England, Flanders, Scandinavia, and even Novgorod in Russia. Its formation was driven by the need to secure trade routes, mitigate the dangers posed by piracy and inconsistent local governance, and create a unified framework for economic collaboration among disparate regions. The League's economic dominance was rooted in its ability to monopolize vital trade goods, including timber, salt, grain, furs, and textiles, effectively controlling the flow of essential commodities across Northern Europe. By leveraging its collective bargaining power, the League negotiated favorable terms with monarchs and local authorities, securing trading privileges and exemptions that reinforced its economic hegemony. One of the Hanseatic League's most profound contributions to medieval commerce was the development of standardized maritime practices, which laid the groundwork for modern sea codes and insurance mechanisms. The League's merchants faced numerous risks inherent in maritime trade, such as shipwrecks, piracy, unpredictable weather, and theft. To address these challenges, the League introduced contractual agreements and legal frameworks designed to protect investments and distribute financial risks. Early forms of marine insurance emerged within this context, whereby merchants pooled resources to compensate for losses incurred during maritime voyages. These agreements were formalized through legal instruments such as the Bottomry contract, which allowed shipowners to secure loans using their vessels as collateral, with repayment contingent upon the safe completion of the voyage. The League's emphasis on risk management was further reinforced by the codification of maritime laws, such as the laws of Wisby, which established regulations for ship conduct, cargo handling, and dispute resolution. These laws, influenced by earlier codes like the Consolato del Mare and the Rolls d'Oleron, became a cornerstone of European maritime law, influencing legal traditions well into the modern era. The League also pioneered the use of joint ventures and partnerships to finance large-scale trading expeditions, allowing merchants to pool capital and share profits proportionally. This practice not only mitigated individual risk, but also facilitated the growth of long-distance trade by enabling the construction of larger, more seaworthy vessels such as cogs, which were well suited for the transport of bulk goods across the North and Baltic Seas. These ships, with their increased cargo capacity and fortified structures, became symbols of the League's dominance in maritime trade. The construction and maintenance of these vessels were supported by the establishment of shipyards in key Hanseatic cities, which became hubs of technological innovation. For example, advances in ship design, such as the adoption of stern rudders and improved rigging systems, enhanced navigational capabilities, and increased the efficiency of sea routes. In addition to their economic and technological contributions, the Hanseatic League's practices had a profound social and political impact on the regions they controlled. The League established contours, or trading outposts, in major commercial centers such as London's Steelyard and Bergen's Bryggen, which served as both economic hubs and enclaves of Hanseatic law and culture. These outposts were governed by strict regulations that ensured the integrity of trade practices, the standardization of weights and measures, and the enforcement of contractual obligations. The contours also acted as centers for knowledge exchange, disseminating information about market conditions, shipping routes, and legal precedents. This dissemination of knowledge contributed to the professionalization of maritime commerce and fostered a sense of collective identity among Hanseatic merchants. The League's influence on marine insurance norms extended beyond risk pooling to the establishment of underwriting practices and the documentation of cargo and voyage details. Merchants were required to provide detailed inventories of their goods and to specify the terms of their agreements, including the valuation of cargo, the anticipated duration of the voyage, and the conditions under which claims could be made. These practices not only reduced fraud and disputes, but also provided a template for the development of modern insurance contracts. The Hanseatic emphasis on documentation and accountability reflected broader trends in medieval commerce, where the increasing complexity of trade necessitated more sophisticated record-keeping and financial instruments. Furthermore, the League's maritime practices were deeply intertwined with the geopolitical dynamics of the time. By controlling critical trade routes and monopolizing key commodities, the League wielded significant political influence, often acting as an intermediary between rival states or as a de facto governing body in regions where centralized authority was weak. This political clout enabled the League to enforce its policies and protect its interests through military means when necessary, such as deploying fleets to combat piracy or to assert dominance over rival trade networks. The League's ability to navigate the complex interplay of commerce and politics exemplifies its role as a precursor to modern multinational corporations, which similarly leverage economic power to influence state policies and international relations. In the context of contemporary debates, the Hanseatic League is often viewed as a model of cooperative economics, demonstrating how decentralized networks can achieve stability and prosperity through collective action. However, its dominance also highlights the challenges of monopolistic practices and the exclusion of non-member merchants, who were often marginalized or subjected to unfavorable terms. These dual legacy underscores the enduring relevance of the League's innovations in maritime commerce, which continue to inform discussions about globalization, trade regulation, and economic integration in the modern era. Through its establishment of trade routes, development of maritime laws, and creation of risk management frameworks, the Hanseatic League not only shaped the commercial practices of its time, but also laid the foundations for the global maritime economy. The creation and development of early sea codes, such as the Rhodian Sea Law, represent a cornerstone in the history of maritime trade and the legal frameworks that govern it. These codes were instrumental in addressing the inherent risks and liabilities of maritime commerce, which was one of the earliest and most critical economic activities connecting diverse civilizations. The Rhodian Sea Law, believed to have originated around 900 BCE on the island of Rhodes, served as one of the first comprehensive legal systems addressing maritime practices. While fragments of the law have survived, its principles have been reconstructed through Roman legal texts, particularly within the Digest of Emperor Justinian compiled in the 6th century CE. The Rhodian Sea Law emphasized equitable treatment of maritime stakeholders and recognized the need for a shared framework to manage risks, such as storms, piracy, and shipwrecks, which were frequent and often catastrophic in ancient seafaring. Its central principle, known as general average, stipulated that the costs incurred by jettisoning cargo to save a vessel in distress should be shared proportionally among all parties with an interest in the voyage, an idea that persists in contemporary marine insurance practices. This legal foundation was complemented by subsequent developments in maritime codes during the Middle Ages, such as the Consulat de Mar, the Rolls of Oleron, and the Lex Mercatoria. The Consulat de Mar, originating in the Mediterranean during the 13th century, systematized and expanded upon earlier principles by addressing specific issues such as the obligations of shipmasters, the rights of crew members, and the liabilities of merchants. Meanwhile, the Rolls of Oleron, which emerged from the island of Oleron off the French Atlantic coast, were pivotal in spreading maritime legal principles across Northern Europe, particularly in England. These early codes not only standardized practices within regions, but also provided mechanisms for resolving disputes, thereby fostering trust and stability in transnational trade networks. They reflected a sophisticated understanding of maritime risk, categorizing perils as either natural, such as storms, or human, such as theft or fraud, and established clear protocols for assigning liability and compensation. From a theoretical perspective, these codes were among the first to integrate the concepts of shared risk and collective liability into a legal framework, laying the groundwork for modern insurance principles. The idea of pooling risk, which underpins marine insurance, can be traced back to these early legal systems. By codifying the shared financial responsibility for losses incurred during maritime ventures, these laws incentivized investment in seaborne trade, even in the face of significant uncertainty. Additionally, the Rhodian Sea Law and its successors embodied a pragmatic approach to justice, recognizing the unique challenges of maritime contexts where traditional land-based laws were often inapplicable. For example, these codes address scenarios such as the necessity for emergency repairs in foreign ports or the division of salvaged goods after a shipwreck, providing practical guidelines that balance the interests of various parties involved in maritime ventures. In practical terms, the influence of these early sea codes extended well beyond their immediate geographical origins. The principles embedded in the Rhodian Sea Law and similar frameworks became deeply ingrained in Roman law and, through it, in the legal systems of later European empires. The incorporation of general average into Roman legal doctrine ensured its transmission into medieval and modern legal traditions, while the customs codified in the Consulat de Mar and the Rolls of Oleron informed the development of admiralty law in England and beyond. These maritime codes also provided the foundation for specialized institutions, such as maritime courts and arbitrators, which played a crucial role in adjudicating disputes and enforcing legal standards across different jurisdictions. Over time, these institutions evolved into formal regulatory bodies that oversaw the burgeoning field of marine insurance, with entities like Lloyd's of London emerging in the 17th century as pivotal hubs for underwriting maritime risks. The impact of early sea codes on contemporary marine insurance cannot be overstated. They established enduring principles that continue to shape the field, such as the equitable distribution of losses, the obligation of utmost good faith in contracts, and the requirement for precise documentation of cargo and voyage details. Modern marine insurance policies still rely on concepts that originated in these ancient and medieval codes, demonstrating their remarkable durability and relevance. However, contemporary debates highlight the complexities of applying these principles in a globalized world with advanced technologies and evolving risks. Issues such as cyber threats to shipping networks, environmental liability for oil spills, and the legal status of autonomous vessels challenge the adaptability of traditional maritime frameworks. Scholars and practitioners alike grapple with the need to balance historical precedents with innovative solutions, ensuring that the foundational principles of fairness, shared responsibility, and risk mitigation remain at the core of marine insurance in an ever-changing landscape. The Age of Discovery, spanning approximately from the 15th to the 17th century, marked a transformative era in global trade and exploration, serving as the crucible for the evolution of marine insurance into a sophisticated financial instrument. During this period, European powers, motivated by the pursuit of wealth, resources, and territorial expansion, embarked on voyages that significantly altered the fabric of global commerce. Central to these developments was the emergence of new trade routes, such as Vasco da Gama's passage to India in 1498 and Christopher Columbus's voyages to the Americas beginning in 1492. These ventures, often funded by monarchs and wealthy merchants, exposed ships and cargo to unprecedented risks, including piracy, severe weather, navigational errors, and political conflicts in foreign territories. The escalating need for financial protection against these dangers catalyzed the formalization and expansion of marine insurance, which had existed in rudimentary form since the ancient Mediterranean civilizations. One of the defining features of the Age of Discovery was the sheer increase in the complexity and scale of maritime trade. European merchants, fueled by a burgeoning demand for exotic goods such as spices, silk, and precious metals, extended their reach into the Americas, Africa, and Asia, creating interconnected trade networks that spanned continents. These networks, however, brought heightened exposure to losses due to the length and uncertainty of voyages. The insurance markets of the time adapted to meet these needs by developing standardized contracts that could apportion risk among multiple stakeholders. For example, the Genoese and Venetian merchants of the 15th century utilized primitive forms of marine insurance contracts, which were later refined in the burgeoning London market. By the 17th century, Lloyd's of London emerged as a pivotal institution, providing not only a venue for underwriting maritime risks, but also a repository for vital shipping information that reduced informational asymmetries between insurers and insured parties. The increased demand for marine insurance during the Age of Discovery also led to the development of actuarial practices aimed at quantifying and pricing risk. Insurers began to analyze historical data on shipwrecks, cargo losses, and piracy incidents to establish premium rates that accurately reflected the likelihood of claims. This was particularly significant in long-distance voyages, where hazards varied greatly depending on the season, the quality of the vessel, and the political stability of the trading regions. For instance, voyages to the East Indies, while highly lucrative, were fraught with dangers such as monsoons, uncharted waters, and hostile encounters with local rulers. Insurers addressed these challenges by introducing clauses that tailored coverage to specific voyages, ensuring that the insured parties understood the limitations and exclusions of their policies. In addition to the technical advancements in underwriting and risk assessment, the Age of Discovery witnessed the emergence of legal and regulatory frameworks designed to prevent the misuse of marine insurance. One of the most significant issues was the practice of deliberate ship scuttling, known as barratry, where ship owners or captains would intentionally destroy vessels to claim insurance payouts. To combat such fraud, insurers and lawmakers implemented strict documentation requirements and established procedures for verifying claims. The Lex Mercatoria, a body of commercial law that governed international trade, played a pivotal role in resolving disputes and standardizing practices across different jurisdictions. Furthermore, the development of general average principles ensured equitable sharing of losses when cargo was jettisoned to save a vessel in distress, reinforcing the cooperative nature of maritime ventures. Another dimension of the evolution of marine insurance during this period was its role in enabling economic expansion and colonialism. By mitigating financial risks, insurance facilitated the pooling of capital necessary for large-scale expeditions, such as those undertaken by the Dutch East India Company and the British East India Company. These joint stock companies relied heavily on marine insurance to attract investors, as it provided a safety net against the potentially catastrophic losses associated with overseas ventures. The premiums paid for these policies often reflected the strategic importance of the voyages, with routes critical to national interests, such as those carrying silver from the Americas to Europe, commanding particularly high rates. Despite its transformative impact, the expansion of marine insurance during the Age of Discovery was not without controversy. Critics argued that the industry, by enabling speculative ventures, contributed to the exploitation of indigenous populations and the intensification of the transatlantic slave trade. Ships carrying enslaved individuals were often insured as cargo, with human lives reduced to monetary valuations. This commodification underscored the moral dilemmas inherent in the insurance practices of the time, prompting later debates about the ethical responsibilities of financial institutions in global trade. Moreover, the innovations in marine insurance during the Age of Discovery laid the groundwork for modern practices. Concepts such as risk pooling, reinsurance, and loss mitigation strategies evolved from the frameworks established in this period. The use of policy documents, known as insurance slips, became a standard practice, allowing for greater transparency and consistency in the underwriting process. These advancements not only supported the growth of international trade, but also contributed to the broader development of financial markets, as marine insurance contracts became tradable instruments in their own right. The interconnected nature of global trade routes established during the Age of Discovery also highlighted the need for collaborative risk management approaches. Insurers, shipowners, and merchants frequently engaged in partnerships that balanced the pursuit of profit with the imperative to safeguard against shared risks. For instance, mutual insurance societies emerged as an alternative to commercial underwriters, particularly among smaller trading communities that lacked access to formal markets. These societies pooled resources to cover losses collectively, exemplifying the community-oriented spirit that underpinned much of the maritime industry during this era. In sum, the Age of Discovery served as a crucible for the evolution of marine insurance, driving innovations that transformed it from a localized and informal practice into a cornerstone of global commerce. The interplay between expanding trade routes, escalating risks, and the demand for financial protection catalyzed advancements in underwriting, actuarial science, and legal frameworks, ensuring the resilience of maritime ventures in an increasingly interconnected world. Reply forward, add reaction. The influence of the Lombards in medieval England represents a transformative chapter in the development of London as a maritime insurance hub, driven by their sophisticated financial innovations and their establishment of Lombard Street as a critical node in the evolution of global commerce. Originating in the northern Italian region of Lombardy, these merchants and financiers brought with them centuries of expertise in credit systems, risk mitigation, and trade facilitation. Their arrival in England during the 13th and 14th centuries coincided with a period of burgeoning trade expansion as England's wool export economy flourished, and its merchants sought to navigate the inherent uncertainties of maritime commerce. The Lombards' contributions can be analyzed through several interconnected dimensions: their pioneering use of financial instruments to manage trade risk, their establishment of a localized yet internationally integrated financial district in Lombard Street, and their lasting impact on the emergence of marine insurance as a specialized practice. Historically, the Lombards were integral to the European commercial revolution, a period marked by the rise of long-distance trade networks linking the Mediterranean with the North Sea and Baltic regions. These trade routes carried not only goods, but also financial innovations such as bills of exchange, a tool that allowed merchants to settle transactions without the physical movement of coinage, thus reducing theft and logistical complexities. When Lombard merchants settled in London, they brought this expertise to a city increasingly reliant on maritime trade. At the time, maritime ventures were fraught with perils, including shipwrecks, piracy, and unpredictable weather, all of which could devastate an investor's capital. The Lombards addressed these challenges by introducing early forms of marine insurance contracts, which distributed the financial risk of maritime ventures among multiple stakeholders. This practice, documented in Italian city-states as early as the 12th century, was adapted to the English context, where it became a cornerstone of commercial activity. The establishment of Lombard Street as the epicenter of their operations in London underscores the centrality of location in the consolidation of financial power. Situated in the heart of the city, Lombard Street served as both a physical and symbolic representation of the Lombards' influence. Its proximity to the Royal Exchange, established in the 16th century by Sir Thomas Gresham, and the Guildhall, the administrative center of the City of London, positioned Lombard Street at the crossroads of trade, governance, and finance. The street itself became synonymous with trust and reliability, as Lombard bankers issued loans, facilitated trade finance, and provided the capital necessary for maritime expeditions. The street's name, derived from these Italian financiers, remains a testament to their enduring legacy. In practical terms, the Lombards' marine insurance practices involved the contractual transfer of risk between the insured and the underwriter, a concept that laid the foundation for modern insurance. These contracts, often written in Latin or Italian, specified the terms under which the underwriter would compensate the insured in the event of loss or damage to a ship or its cargo. This innovation not only provided financial security for merchants, but also enabled the expansion of maritime ventures by attracting a broader pool of investors willing to assume calculated risks. Over time, the basic principles codified in these contracts were formalized into laws and regulations, such as those found in the Lex Mercatoria, or the Law Merchant, which governed commercial transactions across Europe. The Lombards' influence also extended to the cultural and institutional frameworks that supported the burgeoning insurance market. Their integration into London's commercial elite facilitated the exchange of knowledge between Italian and English merchants, leading to the adoption of Italian bookkeeping methods and the establishment of joint stock companies. These developments were instrumental in the rise of insurance syndicates, precursors to the Lloyd's of London market that would dominate marine insurance in later centuries. The cooperative nature of these syndicates mirrored the Lombards' approach to risk sharing, emphasizing collective responsibility and mutual benefit. Contemporary scholars have debated the extent to which the Lombards can be credited with the creation of a distinctly English insurance market. Some argue that their influence was limited to the introduction of Italian practices, which were later adapted by English merchants to suit local needs. Others contend that the Lombards' role was foundational, as their financial expertise and integration into the London market provided the critical impetus for the institutionalization of marine insurance. For example, the work of historians such as Carlo Cipolla and Robert Lopez highlights the broader impact of Italian commerce on European economic development, while English legal historians like Emily Cadens have traced the specific contributions of the Lombards to the evolution of insurance law. The legacy of the Lombards in London can also be examined through the lens of urban geography and its influence on economic activity. The clustering of financial services in Lombard Street created a localized ecosystem of innovation, where merchants, financiers, and insurers could interact and exchange ideas. This agglomeration effect, as described in the economic theories of Alfred Marshall, underscores the importance of proximity in fostering collaboration and knowledge diffusion. In this sense, Lombard Street not only facilitated the practical operations of marine insurance, but also served as a laboratory for the development of financial instruments and practices that would shape the global economy. Moreover, the Lombards' integration into English society reflects the complex interplay between foreign influence and local adaptation. While they initially faced resistance from native merchants and authorities, their contributions to the economy ultimately secured their acceptance and even admiration. This dynamic raises important questions about the role of immigrant communities in economic innovation, a theme that remains relevant in contemporary debates about globalization and migration. The enduring significance of the Lombards in England is evident not only in the continued prominence of Lombard Street as a financial center, but also in the principles and practices they introduced, which remain central to modern insurance and financial systems. By examining their contributions in depth, we gain a deeper understanding of the historical foundations of maritime insurance and the ways in which cultural and institutional exchange shapes economic development. The enactment of the first English marine insurance statute, known as the Marine Insurance Act of 1601, represents a pivotal moment in the formalization and regulation of the marine insurance industry, providing a foundational framework for commercial risk management during the early modern period. Before its enactment, marine insurance had developed organically through customary practices and private agreements, often mediated by guilds and merchant associations, particularly in ports such as London and Bristol. These informal systems, although effective within their local contexts, lacked the uniformity and enforceability required to manage the increasing complexities of international trade, which by the 16th century had expanded significantly due to the advent of transatlantic exploration and the establishment of colonial trade routes. The absence of a standardized legal framework for resolving disputes related to marine insurance policies created inefficiencies and uncertainty, undermining the confidence of merchants and underwriters in these arrangements. The Marine Insurance Act of 1601, therefore, emerged from a specific economic and legal context shaped by England's growing involvement in maritime trade. As international trade intensified, the potential for disputes over insurance contracts grew, necessitating a mechanism to address questions of interpretation, fraud, and equitable treatment. The preamble to the statute explicitly acknowledged that marine insurance had become an essential instrument for mitigating the financial risks inherent in overseas commerce, particularly those arising from shipwrecks, piracy, and adverse weather conditions. These risks, if unmanaged, could not only bankrupt individual merchants, but also destabilize the broader economic networks that underpinned England's nascent empire. The Act aimed to protect the interests of merchants and insurers alike by establishing a dedicated body, the Court of Policies of Assurance, tasked with adjudicating disputes and promoting fairness in the burgeoning marine insurance market. From a theoretical standpoint, the Marine Insurance Act of 1601 can be seen as an early attempt to codify principles of risk-sharing and contractual obligations within a legislative framework. By doing so, it aligned with broader trends in European commercial law, such as the Lex Mercatoria, which sought to harmonize trade practices across different jurisdictions. The act borrowed heavily from practices observed in the Italian city-states, particularly Genoa and Venice, where marine insurance had first been institutionalized during the 13th century. By incorporating these principles, the English statute provided a level of predictability and consistency that facilitated the growth of marine insurance as a legitimate and essential component of maritime commerce. The requirement for written policies and the stipulation that these policies be upheld in a court of law were particularly significant innovations, as they shifted marine insurance from a primarily trust-based arrangement to a legally enforceable contract. In practical terms, the statute's implications were profound. It enabled the development of a more structured marine insurance market in England, centered around prominent hubs such as the Royal Exchange in London. This market attracted not only merchants, but also specialized underwriters and brokers who brought expertise in assessing maritime risks. The creation of a legal framework encouraged greater participation by institutional investors, including joint stock companies like the East India Company, which relied on marine insurance to finance its high-risk voyages to Asia. Furthermore, the statute laid the groundwork for the eventual emergence of Lloyd's of London in the 17th century, which became synonymous with the global marine insurance industry. The Act also served as a model for subsequent legislative efforts in other countries, influencing the development of marine insurance law in the Netherlands, France, and later the United States. From a contemporary perspective, the Marine Insurance Act of 1601 remains a cornerstone of English commercial law, with its principles echoed in modern statutes such as the Marine Insurance Act of 1906. However, its legacy is not without debate. Scholars have questioned whether the Act's emphasis on protecting merchants inadvertently privileged large trading companies at the expense of smaller operators. Others have noted that the statute's focus on adjudicating disputes did not address broader systemic issues, such as the monopolistic tendencies of insurers or the exclusion of certain demographic groups from accessing marine insurance. Nevertheless, the Act's contribution to the formalization and expansion of marine insurance cannot be overstated. By providing a legal foundation for the industry, it transformed marine insurance into a critical enabler of global trade, fostering economic growth and innovation across centuries. Academic references, such as those by John Westcott in A Complete Digest of the Theory, Laws, and Practice of Insurance, 1781, and Sir William Holdsworth's A History of English Law, 1922, emphasize the enduring relevance of this legislative milestone in shaping both the theoretical and practical dimensions of marine insurance as a field. The enactment of the first English marine insurance statute, known as the Marine Insurance Act of 1601, represents a pivotal moment in the formalization and regulation of the marine insurance industry, providing a foundational framework for commercial risk management during the early modern period. Before its enactment, marine insurance had developed organically through customary practices and private agreements, often mediated by guilds and merchant associations, particularly in ports such as London and Bristol. These informal systems, although effective within their local contexts, lacked the uniformity and enforceability required to manage the increasing complexities of international trade, which by the 16th century had expanded significantly due to the advent of transatlantic exploration and the establishment of colonial trade routes. The absence of a standardized legal framework for resolving disputes related to marine insurance policies created inefficiencies and uncertainty, undermining the confidence of merchants and underwriters in these arrangements. The Marine Insurance Act of 1601, therefore, emerged from a specific economic and legal context shaped by England's growing involvement in maritime trade. As international trade intensified, the potential for disputes over insurance contracts grew, necessitating a mechanism to address questions of interpretation, fraud, and equitable treatment. The preamble to the statute explicitly acknowledged that marine insurance had become an essential instrument for mitigating the financial risks inherent in overseas commerce, particularly those arising from shipwrecks, piracy, and adverse weather conditions. These risks, if unmanaged, could not only bankrupt individual merchants, but also destabilize the broader economic networks that underpinned England's nascent empire. The Act aimed to protect the interests of merchants and insurers alike by establishing a dedicated body, the Court of Policies of Assurance, tasked with adjudicating disputes and promoting fairness in the burgeoning marine insurance market. From a theoretical standpoint, the Marine Insurance Act of 1601 can be seen as an early attempt to codify principles of risk-sharing and contractual obligations within a legislative framework. By doing so, it aligned with broader trends in European commercial law such as the Lex Mercatoria, which sought to harmonize trade practices across different jurisdictions. The act borrowed heavily from practices observed in the Italian city-states, particularly Genoa and Venice, where marine insurance had first been institutionalized during the 13th century. By incorporating these principles, the English statute provided a level of predictability and consistency that facilitated the growth of marine insurance as a legitimate and essential component of maritime commerce. The requirement for written policies and the stipulation that these policies be upheld in a court of law were particularly significant innovations, as they shifted marine insurance from a primarily trust-based arrangement to a legally enforceable contract. In practical terms, the statute's implications were profound. It enabled the development of a more structured marine insurance market in England, centered around prominent hubs such as the Royal Exchange in London. This market attracted not only merchants, but also specialized underwriters and brokers who brought expertise in assessing maritime risks. The creation of a legal framework encouraged greater participation by institutional investors, including joint stock companies like the East India Company, which relied on marine insurance to finance its high-risk voyages to Asia. Furthermore, the statute laid the groundwork for the eventual emergence of Lloyd's of London in the 17th century, which became synonymous with the global marine insurance industry. The Act also served as a model for subsequent legislative efforts in other countries, influencing the development of marine insurance law in the Netherlands, France, and later the United States. From a contemporary perspective, the Marine Insurance Act of 1601 remains a cornerstone of English commercial law, with its principles echoed in modern statutes such as the Marine Insurance Act of 1906. However, its legacy is not without debate. Scholars have questioned whether the Act's emphasis on protecting merchants inadvertently privileged large trading companies at the expense of smaller operators. Others have noted that the statute's focus on adjudicating disputes did not address broader systemic issues, such as the monopolistic tendencies of insurers or the exclusion of certain demographic groups from accessing marine insurance. Nevertheless, the Act's contribution to the formalization and expansion of marine insurance cannot be overstated. By providing a legal foundation for the industry, it transformed marine insurance into a critical enabler of global trade, fostering economic growth and innovation across centuries. Academic references, such as those by John Westcott in A Complete Digest of the Theory, Laws, and Practice of Insurance, 1781, and Sir William Holdsworth's A History of English Law, 1922, emphasize the enduring relevance of this legislative milestone in shaping both the theoretical and practical dimensions of marine insurance as a field of reply forward ad reaction. Lord Mansfield's contributions to marine insurance law during the 18th century are foundational, shaping not only the legal frameworks within the United Kingdom, but also influencing global practices in maritime trade and insurance. As Chief Justice of the King's Bench from 1756 to 1788, Lord Mansfield brought a commercial sensibility to English law, particularly in the domain of marine insurance, which was then a burgeoning field critical to the expansion of global trade networks. His decisions bridged the gaps between customary mercantile practices and formal legal principles, ensuring predictability and fairness in an area deeply intertwined with international commerce. At the time, marine insurance was essential for mitigating the risks inherent in maritime ventures, including loss or damage to ships, cargo, and freight caused by perils of the sea, piracy, or capture during wartime. However, this field lacked the legal certainty required for sustained commercial confidence. Mansfield's judicial philosophy emphasized the harmonization of English common law with the established customs of merchants, a principle he operationalized in several landmark cases. One of the most influential cases under Lord Mansfield's tenure was Carter v. Boehm, 1766, which established the foundational doctrine of uberrima fides, or utmost good faith, in marine insurance contracts. The case involved an insurance policy taken out by George Carter for Fort Marlborough, a British trading post in Sumatra, which was captured by the French. The insurers argued that Carter had failed to disclose material information about the fort's vulnerability, which they claimed voided the policy. Lord Mansfield's ruling underscored the necessity of full disclosure in insurance agreements, asserting that the insured must reveal all material facts within their knowledge that would influence the insurer's decision to underwrite the risk. This principle was groundbreaking, emphasizing that insurance contracts require a higher standard of honesty than ordinary commercial agreements because of the asymmetry of information between the parties. Mansfield's reasoning reflected his broader view that legal rules should align with the realities of commerce, and his articulation of the duty of utmost good faith became a cornerstone of marine insurance law, later codified in Section 17 of the Marine Insurance Act of 1906. Another critical case was Hamilton v. Mendez, 1761, in which Lord Mansfield clarified the principle of indemnity, the cornerstone of insurance contracts. The case concerned whether an insured party could claim compensation for a partial loss when the insured value exceeded the actual value of the cargo. Mansfield ruled that the purpose of insurance was to indemnify the insured against actual loss, not to provide a speculative profit. This decision reinforced the principle that insurance is a contract of indemnity, aiming to restore the insured to the financial position they would have been in had the loss not occurred, without allowing for unjust enrichment. This principle remains fundamental to insurance law today, shaping the interpretation of policy terms and the calculation of claims. Mansfield's influence extended beyond individual cases to the broader conceptualization of marine insurance as an integrated part of international trade law. His decisions recognized that maritime commerce operated across jurisdictions and required consistent legal principles to facilitate trade. By incorporating mercantile customs into the common law, Mansfield laid the groundwork for a more unified legal framework, which ultimately influenced the drafting of the Marine Insurance Act of 1906. This act, largely based on the principles Mansfield articulated, was authored by Sir Mackenzie Dalzell Chalmers and remains a key legislative text governing marine insurance. It codified several doctrines that Mansfield had pioneered, including utmost good faith, indemnity, and proximate cause, providing clarity and consistency for insurers and insureds alike. The principle of proximate cause, which determines the dominant cause of loss in insurance claims, was also shaped by Lord Mansfield's rulings. His decision in Lawrence v. Aberdeen, 1780, elucidated the need to establish a direct causal link between the insured peril and the loss claimed, precluding insurers from denying claims based on tangential or unrelated factors. This principle addressed the practical challenges of attributing losses in complex maritime scenarios, where multiple factors often contribute to an event. The Marine Insurance Act of 1906 later codified this principle in Section 55, specifying that insurers are liable only for losses proximately caused by the insured peril unless otherwise excluded by the policy. Mansfield's jurisprudence also engaged with the interpretation of warranties in marine insurance, which are promises or conditions stipulated in the policy. His rulings emphasize strict compliance with warranties, reflecting the commercial need for certainty in underwriting risks. For example, in Tatham v. Hodgson, 1781, Mansfield upheld the insurer's right to deny coverage when the insured failed to comply with a warranty regarding the ship's route, even though the deviation had no causal connection to the loss. This strict approach to warranties ensured that insurers could rely on the terms of the policy as a basis for assessing risk, a principle codified in Sections 33 and 34 of the Marine Insurance Act of 1906. Lord Mansfield's integration of commercial practices into legal principles also set the stage for the internationalization of marine insurance law. His rulings were widely cited in the courts of other maritime nations, influencing the development of marine insurance practices in the United States, France, and beyond. For instance, the adoption of the doctrine of utmost good faith in American marine insurance law can be traced directly to Mansfield's reasoning in Carter v. Boehm. Similarly, his emphasis on the principle of indemnity resonated with the practices of continental European insurers, contributing to the harmonization of maritime law across jurisdictions. Mansfield's legacy is not without critique, as some scholars argue that his reliance on mercantile customs risked privileging the interests of insurers and merchants over those of individual policyholders. Others contend that his approach to warranties, while commercially pragmatic, created a rigid framework that could be unfair to insured parties in certain circumstances. Nonetheless, his decisions reflect a profound understanding of the interplay between law and commerce, and their enduring relevance underscores their foundational importance to marine insurance law. By synthesizing the customs of merchants with the principles of common law, Mansfield established a legal framework that not only supported the growth of maritime trade during the 18th century, but also provided the basis for the global marine insurance industry as it exists today. Reply forward to add reaction. Marine insurance in the United States has a history deeply intertwined with the nation's early economic and legal development, reflecting both its maritime origins and the broader evolution of corporate governance and risk management practices. The introduction of marine insurance to the United States can be traced back to the colonial period, where American merchants relied heavily on British insurers such as Lloyd's of London for coverage against the perils of transatlantic trade. The lack of domestic underwriting options was a direct result of the colony's dependence on British financial systems, coupled with the nascent state of American commerce. However, as American independence took shape in the late 18th century, the need for a domestic marine insurance industry became apparent, spurred by the burgeoning growth of trade in major port cities like Boston, New York, and Philadelphia. In 1794, the establishment of the Insurance Company of North America in Philadelphia marked the formal beginning of marine insurance underwriting on American soil. This corporation not only became the first domestic insurance entity in the United States, but also laid the groundwork for structured risk pooling, corporate accountability, and financial innovation, providing merchants with policies that address specific hazards such as shipwreck, piracy, and natural disasters. The early marine insurance landscape in the United States was shaped by an environment of intense competition, legal uncertainty, and evolving economic priorities. Initially, many marine insurers were organized as proprietary corporations, often backed by wealthy merchants who sought to diversify their financial portfolios while supporting maritime commerce. These corporations operated under charters granted by state legislatures, which often imposed limitations on the scope of their business and their ability to raise capital. The risk appetite of these early insurers was generally conservative, focusing on well-documented voyages with experienced captains and seaworthy vessels. Nevertheless, the industry faced significant challenges, including insufficient actuarial data, the unpredictability of maritime losses, and the occasional insolvency of undercapitalized firms. By the mid-19th century, these challenges prompted the emergence of mutual insurance companies, which operated on a fundamentally different principle by allowing policyholders to share both the risks and profits of the business. Mutual companies, such as those based in Boston and New York, offered lower premiums and a more democratic governance structure, which appealed to smaller merchants and shipowners who were otherwise excluded from proprietary insurance markets. One of the defining features of the early American marine insurance industry was its relationship with the legal and regulatory framework of the time. Maritime law in the United States drew heavily from English common law traditions, particularly in the areas of contract enforcement and liability. Early marine insurance policies were often complex and highly customized, requiring careful negotiation between insurers and policyholders. Courts played a critical role in adjudicating disputes, which ranged from ambiguous contract language to contentious claims over total losses and partial damages. Notable legal precedents, such as those set by Justice Joseph Story in the early 19th century, helped to establish key doctrines in marine insurance law, including the principles of utmost good faith and indemnity. These legal foundations not only provided greater predictability in underwriting practices, but also encouraged the growth of marine insurance as a legitimate and indispensable component of American commerce. The rapid expansion of the marine insurance industry in the United States during the 19th century can also be attributed to the rise of corporate capitalism and technological advancements in shipping. The proliferation of steamships, the construction of major canals such as the Erie Canal, and the opening of transoceanic trade routes significantly increased the volume and complexity of maritime commerce. Insurers responded by developing more sophisticated underwriting techniques, incorporating probabilistic analysis and leveraging advances in statistics to better assess risks. Additionally, the introduction of reinsurance agreements allowed marine insurers to manage their exposure to catastrophic losses by spreading risks across multiple entities. By the late 19th century, American marine insurers were competing not only with one another, but also with well-established European firms, necessitating innovations in policy design and claims management. Despite these advancements, the industry remained susceptible to economic downturns, such as the Panic of 1873, which exposed the vulnerabilities of poorly capitalized firms and prompted calls for stricter regulatory oversight. The competitive dynamics of the marine insurance industry during this period were further complicated by geopolitical factors, including wars, trade embargoes, and shifting economic alliances. For example, the War of 1812 disrupted American maritime trade and forced many insurers to reevaluate their exposure to wartime risks. Similarly, the rise of global shipping conglomerates in the late 19th century created new opportunities and challenges for American marine insurers, as they sought to balance the demands of large commercial clients with the needs of smaller regional markets. The interplay between these macroeconomic forces and the internal dynamics of the industry highlights the adaptability and resilience of marine insurance as a cornerstone of American commerce. As the 20th century approached, the marine insurance industry in the United States began to consolidate, with larger firms absorbing smaller competitors and expanding their geographic reach. This period of corporate growth was characterized by the standardization of policy language, the establishment of industry associations such as the American Institute of Marine Underwriters, and the increasing use of technology to streamline operations. These developments not only enhanced the efficiency and reliability of marine insurance, but also reinforced its critical role in facilitating global trade and economic development. The Civil War significantly disrupted the American marine insurance market, presenting challenges that necessitated the revival and adaptation of existing structures while fostering the emergence of innovative solutions, particularly mutual and non-assessment insurance companies. At its core, marine insurance is a mechanism for transferring and mitigating risk associated with maritime ventures, a necessity for trade and commerce that predates modern financial systems. However, the Civil War introduced an unparalleled scale of risk, including Union naval blockades, Confederate commerce raiders, and an increase in privateering activities, which collectively destabilized maritime trade routes and exposed the vulnerabilities of traditional marine insurers. These risks were compounded by the fragmentation of the national economy, with the Union and Confederacy operating under distinct legal and regulatory frameworks, further complicating underwriting practices and claim settlements. Historical records from insurance companies during the war indicate that underwriting losses increased exponentially, with many firms forced into insolvency as premiums failed to keep pace with wartime losses, particularly for vessels operating in contested waters or engaged in blockade running. The resurgence of marine insurance during this period can be attributed to the innovative responses to these challenges, notably the establishment of mutual insurance companies. Unlike traditional stock-based insurers, mutual companies were owned by their policyholders, allowing them to pool resources and distribute risks more equitably. This model proved particularly resilient during the war, as it aligned the interests of insurers and insured parties, fostering a sense of collective responsibility and financial stability. Mutual insurers also implemented non-assessment policies, a groundbreaking adaptation designed to address the unpredictability of wartime losses. Under non-assessment agreements, policyholders were not liable for additional contributions beyond their initial premium payments, a departure from the traditional practice of issuing supplementary assessments to cover unexpected losses. This innovation not only enhanced the appeal of mutual insurance, but also provided a buffer against the volatility of wartime commerce, enabling these companies to sustain operations and even expand their market share. The Civil War also prompted a reevaluation of underwriting practices, particularly the assessment of wartime risks. Marine insurers began to incorporate broader geopolitical considerations into their risk models, recognizing the impact of naval strategies, port access, and the shifting allegiances of foreign powers on maritime trade. For instance, the prevalence of Confederate commerce raiders such as the CSS Alabama and the CSS Shenandoah highlighted the need for insurers to differentiate between direct military risks and ancillary threats, such as the disruption of shipping routes and the increased likelihood of ship seizures. Premiums for voyages through high-risk areas, such as the Gulf of Mexico and the Atlantic seaboard, often reached unprecedented levels, reflecting the heightened probability of loss. Simultaneously, insurers operating in Union-controlled territories benefited from the relative stability provided by the Union Navy's dominance, which secured key trade routes and minimized disruptions to northern shipping interests. The adaptation of marine insurance during the Civil War was further shaped by the broader economic implications of the conflict, including the inflationary pressures and resource scarcities that affected both the Union and Confederate economies. Insurers had to navigate fluctuating currency values, uneven access to capital, and the evolving legal frameworks governing maritime commerce, particularly in the South, where Confederate authorities sought to establish their own insurance infrastructure. Archival evidence suggests that Southern insurers faced significant challenges in maintaining solvency, given the limited availability of premium-paying customers and the high likelihood of claims arising from Union blockades and raids. In contrast, Northern insurers, particularly those based in New York and Boston, leveraged their access to international markets and capital to underwrite larger volumes of policies, often partnering with European reinsurers to spread their risks. This period also saw the introduction of specialized war risk policies, which provided coverage for losses directly attributable to military actions, a precursor to modern war insurance. The interplay between domestic and international forces during the Civil War also underscored the interconnectedness of the marine insurance market. American insurers relied heavily on European reinsurers to offset their exposures, particularly in high-risk areas such as the Caribbean and the Gulf of Mexico. However, the war strained these relationships, as European underwriters became increasingly reluctant to reinsure American policies due to the heightened likelihood of loss. This reluctance forced American insurers to develop more sophisticated risk assessment tools and diversify their portfolios to include less volatile markets, such as coastal shipping and inland waterways. Additionally, the war highlighted the strategic importance of marine insurance in supporting national economic resilience. By facilitating the continued operation of merchant fleets and enabling the financing of maritime ventures, marine insurers played a critical role in sustaining the Union's industrial and agricultural output, as well as the Confederacy's attempts to circumvent blockades and secure vital imports. In analyzing the broader implications of the Civil War on marine insurance, it is essential to consider the long-term impact of these wartime adaptations on the industry as a whole. The innovations introduced during this period, including mutual insurance models, non-assessment policies, and war risk coverage, laid the foundation for modern practices in risk management and underwriting. Moreover, the war underscored the need for regulatory oversight and standardized practices, leading to the eventual establishment of state-level insurance commissions and the development of industry-wide guidelines for assessing and pricing maritime risks. Contemporary scholarship, including works by marine insurance historians such as John McCusker and William Cronin, highlights the Civil War as a pivotal moment in the evolution of the industry, demonstrating the capacity of insurers to adapt to extreme circumstances and contribute to broader economic stability. By examining the historical, theoretical, and practical dimensions of marine insurance during the Civil War, we gain a deeper understanding of the resilience and adaptability of this vital industry in the face of systemic challenges. The period following World War I marked a pivotal transformation in the marine insurance industry, particularly with the expansion of American insurers and the establishment of cooperative frameworks that solidified the sector's growth and resilience. Prior to the war, marine insurance was heavily concentrated in European markets, with British firms, especially those operating within Lloyd's of London, dominating global underwriting practices. However, the war introduced profound disruptions to international trade, exposing vulnerabilities in this centralized system and underscoring the need for diversification. The massive losses experienced during the war, including the sinking of merchant vessels by submarines, the destruction of cargo due to naval blockades, and the increased costs of insuring wartime risks, placed unprecedented strain on the industry. In response, the global insurance market began to recalibrate, with the United States emerging as a significant new player, driven by the country's expanded merchant fleet and the desire to protect its burgeoning maritime economy from external dependencies. Historically, the United States had relied on European insurers to underwrite much of its maritime risk. However, the war catalyzed a shift toward domestic solutions, as American policymakers and business leaders recognized the strategic importance of developing a robust, independent marine insurance infrastructure. The establishment of the United States Shipping Board during the war played a critical role in building the nation's shipping capacity, laying the groundwork for a more substantial insurance market. After the war, several American insurance companies, including the American Marine Insurance Syndicate, emerged to meet the growing demand for domestic underwriting services. These companies were bolstered by legislative measures, such as the Merchant Marine Act of 1920, which aimed to support the growth of the American merchant fleet and ensure that insurance for these vessels remained under domestic control. This period also saw the creation of specialized organizations, such as the United States Salvage Association, which provided technical expertise in recovering damaged or lost maritime assets, further enhancing the competitiveness of American insurers. The expansion of American marine insurance was also characterized by the development of cooperative efforts designed to stabilize the market and manage risks more effectively. These efforts included the formation of pooling agreements, where multiple insurers would share underwriting responsibilities to mitigate individual exposure to large losses. For instance, American insurers adopted the concept of general average, a principle that had long been a cornerstone of European marine insurance, whereby all parties involved in a maritime venture would proportionally share the costs of losses incurred to save the voyage. This principle was adapted and refined in the American context, fostering a sense of collective responsibility and reducing the financial burden on individual insurers. Additionally, the establishment of rating bureaus provided a standardized framework for assessing and pricing risks, ensuring consistency across the industry and promoting fair competition. Theoretical advancements in risk management during this period also played a significant role in shaping the post-war marine insurance landscape. The war had demonstrated the importance of statistical analysis and actuarial science in predicting and managing maritime risks. American insurers began to adopt more sophisticated methods for evaluating probabilities of loss, incorporating data on weather patterns, shipping routes, and wartime hazards into their underwriting models. This analytical approach not only improved the accuracy of risk assessments, but also enabled insurers to offer more competitive rates, attracting a broader range of clients. The practical application of these methods was evident in the development of specialized policies tailored to the unique needs of American shippers, such as coverage for coastal trade routes and inland waterways, which had previously been underserved by European insurers. The rise of American marine insurers was not without its challenges, as the industry faced intense competition from established European firms seeking to regain their pre-war dominance. Contemporary debates during this period often revolved around the balance between nationalism and globalization in the insurance market. While American insurers prioritized the protection of domestic shipping interests, critics argued that overly protectionist policies could stifle innovation and limit access to international markets. Moreover, the rapid expansion of the industry raised concerns about regulatory oversight, as policymakers sought to ensure that the growing number of insurers adhered to standards of solvency and ethical conduct. These debates highlighted the tension between the industry's economic ambitions and its social responsibilities, a theme that continues to resonate in contemporary discussions about marine insurance. In addition to economic and regulatory factors, the post-war expansion of American marine insurance was deeply influenced by broader geopolitical dynamics. The United States' emergence as a global economic power was accompanied by a corresponding shift in the balance of maritime trade, with American ports becoming key hubs for international commerce. This shift created new opportunities for American insurers to establish themselves as leaders in the global market, while also necessitating greater collaboration with foreign counterparts. Cooperative efforts during this period often extended beyond national borders, as American insurers participated in international conferences and trade associations to share best practices and address common challenges, such as piracy, environmental hazards, and the standardization of policy terms. The growth of American marine insurance after World War I was thus a multifaceted process, shaped by a complex interplay of historical, economic, theoretical, and practical factors. This transformative period laid the foundation for a more diversified and resilient industry, driven by innovation, cooperation, and a commitment to meeting the evolving needs of the maritime community. The lessons learned during this era continue to inform contemporary practices, offering valuable insights into the dynamics of risk management, international collaboration, and the enduring importance of marine insurance in a rapidly changing world. The Marine Insurance Act of 1906 stands as one of the most significant legislative frameworks in the history of insurance law, providing a codified structure for principles that had long governed marine insurance practices. Enacted by the British Parliament, this legislation aimed to consolidate and formalize centuries of judicial precedents and customary practices within the marine insurance industry, creating a definitive reference for insurers, insured parties, brokers, and courts. At its core, the Marine Insurance Act of 1906 addresses foundational principles such as insurable interest, utmost good faith, and warranties, each of which has shaped the legal and practical landscape of marine insurance not only in the United Kingdom but across jurisdictions worldwide. The concept of insurable interest, as articulated in Section 5 of the Act, establishes that a party must have a legal or equitable interest in the subject matter insured to purchase a valid policy. This principle prevents insurance from being used as a speculative tool, requiring that the insured party suffer a financial loss upon the occurrence of the insured event. Historically, the doctrine of insurable interest evolved from 18th century cases such as Lucena versus Crawford in 1806, where the House of Lords emphasized the necessity of a financial stake tied to the preservation of the insured property. Under the 1906 Act, insurable interest is broadly interpreted to include various stakeholders, such as shipowners, cargo owners, and charterers, thus ensuring that all parties with a legitimate financial exposure can obtain coverage. However, this principle has spurred debates in modern contexts, particularly in relation to reinsurance contracts and indirect interests, where some courts have adopted a more flexible interpretation, allowing the principle to evolve alongside the complexities of global commerce. The doctrine of utmost good faith, expressed in the Latin term uberrima fides, is codified under Section 17 of the Marine Insurance Act. This principle requires both the insured and the insurer to disclose all material facts relevant to the risk being underwritten, ensuring transparency and fairness in the contractual relationship. Material facts, as defined in Section 18, are those which would influence a prudent underwriter's decision to accept the risk or set premium rates. The roots of this doctrine can be traced to Lord Mansfield's decision in Carter v. Boehm in 1766, which established the duty of disclosure in insurance contracts. The Marine Insurance Act crystallized this duty, making non-disclosure or misrepresentation grounds for voiding a policy. In practice, this requirement places a significant burden on the insured to disclose all known information, which has led to disputes over what constitutes a material fact and how much diligence is required. For example, debates have arisen concerning the extent to which modern technologies, such as satellite tracking and advanced weather modeling, alter the scope of disclosure. Additionally, the principle of utmost good faith has been criticized for its asymmetry, as insurers often rely on policy terms to deny claims while remaining less stringent in their own disclosure obligations during contract negotiations. Warranties, detailed in Sections 33 to 41 of the Act, represent conditions precedent to the insurer's liability. A warranty may be either explicitly stated in the policy, or implied, as inferred from the nature of the risk. One of the most significant implied warranties under the Act is the warranty of seaworthiness, which obligates the insured to ensure that the vessel is fit for its intended voyage at the commencement of the journey. Breach of a warranty, even if unrelated to the loss, discharges the insurer from liability as a matter of strict law, underscoring the critical nature of compliance. This strict interpretation has drawn considerable scrutiny, particularly in cases where minor breaches of technical warranties have led to the denial of substantial claims. For instance, in the case of the Good Luck in 1991, the court upheld the strict application of warranties despite arguments for a more equitable approach. In recent years, the rigid treatment of warranties has been softened in some jurisdictions through legislative reform, such as the Insurance Act of 2015 in the United Kingdom, which introduced proportionate remedies for breach of warranties, reflecting a growing recognition of the need for balance between insurers and insureds. The enduring influence of the Marine Insurance Act of 1906 on global practices cannot be overstated. Its principles have been adopted, either directly or indirectly, in numerous common law jurisdictions, including Australia, Canada, and India. Even in jurisdictions governed by civil law traditions, such as France and Germany, the Act's emphasis on standardization and clarity has inspired comparable frameworks in maritime insurance law. For example, the Hamburg Rules and the United Nations Convention on Contracts for the International Sale of Goods have incorporated aspects of the Act's approach to risk allocation and contract formation. Nevertheless, the Act has faced challenges in adapting to the complexities of 21st century commerce, particularly with the rise of containerized shipping, cyber risks, and environmental liabilities. The rapid growth of data-driven technologies and predictive analytics has further complicated the application of traditional principles, prompting calls for amendments to address emerging risks. Scholars and practitioners continue to debate whether the Act's foundational doctrines, such as utmost good faith, should be reinterpreted or replaced to reflect the realities of contemporary global trade, where information asymmetries and contractual flexibility differ significantly from the conditions of 1906. Despite its age, the Marine Insurance Act of 1906 remains a cornerstone of marine insurance law, celebrated for its clarity and comprehensiveness. Its legacy endures not only through direct application, but also through its influence on legislative and judicial developments worldwide. Legal scholars frequently cite the Act as a model of codification, pointing to its ability to synthesize complex doctrines into a cohesive legal framework. However, this very codification has also led to criticisms that the Act may inhibit the evolution of marine insurance law in rapidly changing economic and technological landscapes. The tension between historical continuity and modern adaptability continues to shape discussions about the future of the Act, ensuring its relevance as a focal point of academic and professional inquiry in the field of marine insurance. World War II stands as a pivotal event in the history of marine insurance, radically altering its structure, operational paradigms, and the underlying risk landscape. Before the war, marine insurance was largely governed by private enterprises operating within frameworks established during the Industrial Revolution, relying on actuarial data, historical precedent, and market-driven risk assessments. However, the outbreak of global conflict introduced unprecedented challenges, including the pervasive threat of naval warfare, widespread destruction of maritime infrastructure, and the need to secure vast fleets of cargo vessels and warships. The involvement of Axis and Allied powers in large-scale naval engagements, such as the Battle of the Atlantic, saw merchant vessels targeted by submarines, surface raiders, and aircraft, introducing new categories of risk that private insurers were ill-equipped to manage independently. Consequently, government intervention became a defining characteristic of marine insurance during this period, as states recognized the strategic importance of maintaining supply chains for military and civilian purposes. One of the earliest and most significant shifts was the creation of state-backed war risk insurance schemes. In the United Kingdom, for instance, the War Risks Insurance Act of 1939 established the framework for government indemnification of losses resulting from enemy action, as traditional insurers either refused coverage or imposed prohibitively high premiums due to the uncertainty surrounding wartime risks. Similar measures were adopted in the United States under the Merchant Marine Act of 1936, which allowed the federal government to charter private vessels and provide financial protection for shipowners against wartime perils. These government programs were essential in mitigating the economic disruption that would have occurred had marine insurance markets been left to collapse under the weight of wartime demands. They also ensured that essential goods, including food, ammunition, and medical supplies, continued to flow to theaters of conflict, thereby directly influencing the outcome of the war. Additionally, these interventions marked a significant departure from the laissez-faire principles that had previously dominated the industry, paving the way for more collaborative relationships between public and private stakeholders. The war also necessitated significant adjustments in underwriting practices and the scope of coverage offered by marine insurers. Traditional underwriting models, which relied heavily on historical loss ratios and fixed routes of navigation, were rendered obsolete as shipping lanes were rerouted to avoid contested areas and vessels were frequently requisitioned for military use. Insurers were forced to adopt more dynamic and adaptive approaches, integrating real-time intelligence on geopolitical developments and advancements in naval technology. For example, the widespread deployment of convoy systems, designed to protect merchant ships from submarine attacks, introduced a new variable into risk calculations, as the presence of naval escorts reduced the likelihood of total losses, but increased the potential for partial damages due to isolated incidents of enemy engagement. Similarly, the use of innovative technologies such as sonar and radar, which enhanced the detection of other threats, played a role in reshaping risk assessments, albeit with varying degrees of effectiveness depending on the theater of operations and the sophistication of enemy tactics. From a legal and contractual perspective, the war prompted significant revisions to marine insurance policies, particularly concerning the definition and exclusion of war risks. Standard clauses such as the free of capture and seizure provision, which historically excluded losses arising from acts of war or piracy, were revisited to accommodate the realities of global conflict. In some cases, insurers introduced supplemental war risk policies, often underwritten in collaboration with government entities, to provide coverage for specific contingencies such as torpedo damage, mine strikes, or aerial bombardment. These policies were characterized by complex and often contentious negotiations over premium rates, liability limits, and the allocation of losses between private insurers and public guarantors. The war also saw an increase in the use of reinsurance as a mechanism for spreading risk across multiple entities, thereby enhancing the resilience of the marine insurance market. Reinsurance treaties, often facilitated by government agencies, enabled insurers to manage the extraordinary financial pressures associated with wartime claims, while also fostering greater international cooperation within the industry. The post-war period brought its own set of challenges and opportunities, as marine insurers grappled with the need to adapt to a transformed global landscape. The reconstruction of devastated shipping fleets, ports, and maritime infrastructure required substantial investment and innovative approaches to risk management. At the same time, the advent of containerization, jet propulsion, and nuclear-powered vessels introduced new technical and operational risks that demanded updated underwriting standards and coverage models. Furthermore, the emergence of international regulatory frameworks, such as the General Agreement on Tariffs and Trade and the establishment of the International Maritime Organization, created additional layers of complexity for insurers operating in an increasingly interconnected global economy. These developments underscored the need for continued collaboration between public and private stakeholders, as well as the importance of leveraging technological advancements to enhance the precision and efficiency of risk assessments. Marine insurance during and after World War II serves as a compelling case study in resilience, adaptation, and the interplay between market forces and government intervention. The industry's response to wartime demands not only ensured the continuity of vital supply chains, but also laid the foundation for its evolution into a more sophisticated and globally integrated system. Today, the legacy of these wartime transformations can be seen in the continued emphasis on data-driven decision-making, the proliferation of specialized coverage options, and the ongoing dialogue between insurers, regulators, and policymakers regarding the management of emerging risks in an era of geopolitical uncertainty and technological innovation. Through an exhaustive analysis of these historical and contemporary dynamics, one gains a deeper appreciation for the enduring relevance of marine insurance as a cornerstone of global trade and economic stability. Modern marine insurance is a complex and multifaceted industry that has evolved from ancient practices of risk-sharing and mutual protection into a sophisticated global marketplace driven by legal frameworks, economic dynamics, and technological innovation. The roots of marine insurance trace back to antiquity, when merchants and traders pooled resources to share the risks associated with maritime ventures, such as shipwrecks, piracy, and adverse weather conditions. Early forms of marine insurance were seen in Babylonian contracts, such as those codified in the Code of Hammurabi, which outlined rudimentary risk-sharing arrangements tied to maritime trade. Similarly, the Roman Republic developed primitive forms of mutual indemnity through associations like collegia that pooled funds to cover losses. However, the first recognizable marine insurance contracts emerged in the medieval period in Italian city-states like Genoa and Venice, where merchants formalized policies covering specific voyages. These agreements served as the foundation for modern practices, particularly as they introduced the concept of premiums and compensation proportional to insured value. The emergence of marine insurance as a formal industry occurred in 17th-century England, with Lloyd's Coffee House in London playing a pivotal role. Lloyd's became a hub for maritime commerce, where underwriters and shipowners gathered to negotiate and document risks associated with international trade. The Lloyd's market solidified key principles of marine insurance, such as the utmost good faith doctrine, which requires full disclosure of all material facts by the insured to ensure accurate risk assessment. This principle, along with the concept of indemnity, where insurance aims to restore the insured to their original financial position, became central to marine insurance law and practices globally. The passage of the Marine Insurance Act of 1906 in the United Kingdom codified these principles, establishing a comprehensive legal framework that continues to influence underwriting and claims practices worldwide. The Act defined essential concepts such as insurable interest, warranties, proximate cause, and the distinction between total and partial loss, creating a benchmark for other jurisdictions. Theoretical advancements in marine insurance during the 18th and 19th centuries aligned with broader developments in economics and statistics. The rise of actuarial science allowed underwriters to move beyond anecdotal experience, employing probability models to estimate loss frequency and severity. Marine insurers began to systematically assess risks associated with specific routes, ship types, cargo classes, and geopolitical factors. These practices were further refined as global trade expanded during the Industrial Revolution, introducing new risks such as mechanical breakdowns in steamships, larger volumes of cargo, and longer trading distances. Marine insurers adapted by creating specialized coverage options, including hull insurance for vessels, cargo insurance for goods, and protection and indemnity insurance for third-party liabilities. The modern era of marine insurance is characterized by its integration with advanced technology and its responsiveness to contemporary challenges such as climate change, cyber risks, and geopolitical instability. The digitization of marine insurance has revolutionized underwriting, claims processing, and risk modeling. Satellite data, Internet of Things devices, and blockchain technology are now widely employed to monitor shipping activities, detect anomalies, and streamline policy issuance. For example, real-time tracking of vessels enables dynamic risk assessment, allowing underwriters to adjust premiums based on changing conditions such as weather or geopolitical events. Similarly, blockchain-based platforms are being used to improve transparency and reduce fraud in marine insurance transactions by providing immutable records of policy terms, claims, and payouts. Legal precedents also continue to shape marine insurance practices, particularly as courts interpret and apply historical principles to novel circumstances. Landmark cases, such as the Star Sea and the Good Luck, have clarified the scope of warranties and the duty of disclosure in modern contexts, ensuring that marine insurance law remains adaptable to evolving trade practices. These legal decisions often highlight tensions between traditional doctrines and contemporary market realities, prompting ongoing debates about the relevance and fairness of existing rules. Marine insurance underwriting today is influenced by macroeconomic trends, including fluctuating commodity prices, shipping demand, and global trade patterns. For instance, the growth of containerized shipping and the increasing size of vessels have introduced new aggregation risks, where a single catastrophic event could result in unprecedented claims. Underwriters must account for such scenarios by implementing rigorous risk aggregation controls and reinsurance arrangements. Additionally, climate change poses significant challenges to marine insurers, with rising sea levels, stronger storms, and shifting weather patterns increasing the frequency and severity of losses. Insurers are responding by incorporating climate risk models into their pricing and reserving strategies, as well as advocating for sustainable shipping practices through initiatives like the Poseidon Principles. Technological advances are also creating opportunities for innovation in product offerings and risk management. Parametric insurance, which provides predetermined payouts based on objective triggers such as wind speed or wave height, is gaining traction as a complement to traditional indemnity-based policies. Such products reduce the administrative burden of claims adjustment while providing faster compensation to policyholders. Moreover, the rise of autonomous ships and unmanned underwater vehicles is reshaping risk landscapes, requiring insurers to develop new underwriting frameworks that address liability issues, cybersecurity threats, and potential malfunctions in artificial intelligence systems. The modern marine insurance market operates within a highly interconnected global framework, with leading hubs such as London, Singapore, and New York, serving as centers for underwriting, brokerage, and arbitration. The International Union of Marine Insurance, founded in 1874, continues to play a vital role in promoting standardization and knowledge sharing among industry stakeholders. At the same time, Regional variations in legal regimes, regulatory requirements, and market practices create both challenges and opportunities for insurers seeking to operate across borders. In practical terms, the process of marine insurance underwriting involves a detailed evaluation of multiple factors, including the type and condition of the vessel, the nature and value of the cargo, the proposed voyage route, and the financial stability of the insured. Underwriters rely on historical loss data, market intelligence, and predictive analytics to price policies competitively, while ensuring adequate reserves for potential claims. Collaboration between underwriters, brokers, and loss adjusters is essential to maintaining the integrity and efficiency of the marine insurance value chain. For instance, brokers act as intermediaries who help clients navigate complex policy terms, while loss adjusters investigate claims to determine the extent of coverage and recommend appropriate settlements. Despite its robust foundations, the marine insurance industry faces ongoing debates about its role in addressing systemic risks such as economic inequality, environmental degradation, and global security threats. Some critics argue that traditional underwriting models perpetuate disparities by favoring established markets and well-capitalized clients, while others call for greater emphasis on sustainability and resilience in policy design. These discussions underscore the need for marine insurers to balance profitability with social and environmental responsibility, ensuring that the industry remains relevant and resilient in the face of future challenges.